Hello, this is Kent Kramer. I'm the Chief Investment Officer at Foster Group. Foster Group is our independent registered investment advisor, and we're based in West Des Moines, Iowa. We also have an office in Omaha, Nebraska. And with me today is Zach Dalluge. Zach is an associate advisor. And like me, Zach is a political junkie. We've both worked in and around the Iowa legislature at different times. So this topic is of particular interest to Zach as well. Zach joined Foster Group in 2018. So Zach, welcome, and tell us a little bit about what got you interested in this law and when it crossed your radar screen.
Yeah, thanks, Kent. So prior to joining Foster Group, I spent some time during college, then after college, working in the political world as both a legislative staff member and a lobbyist. Since joining Foster Group, I've taken an interest in following policy that relates to individuals' financial lives. Much of the way we build financial plans and invest is impacted by public policy, not just the markets and investments, but also on the planning side. So news about the Secure Act began early in 2019, and I've enjoyed following through the process.
The law in December of 2019 with bipartisan support, which in today's environment, sometimes we don't hear much about bills that have support on both sides of the aisle. Can you tell us a little bit about who are the original sponsors of the bill and what they were trying to address?
Yep, so on the House side, the lead sponsor was Congressman Richard Neal from Massachusetts. He chairs the House Ways and Means Committee. And there was an additional 57 co-sponsors made up of both parties on the bill as well. And the bill passed the House of Representatives 417-3 back in May. So on the Senate side, there was a similar bill that was introduced by actually our local senator here, Chuck Grassley, who chairs the Senate Finance Committee. The bill was held up in the Senate due to some disagreements amongst the members, but in late December was actually attached to a 2020 budget bill, which passed both the House and the Senate and was signed into law by the president, like you said, in December 20th of 2019. So the original push behind the bill was the rising number of Americans having nothing or little saved for retirement. The bill contains several provisions to encourage people to save more and make it easier for businesses to sponsor retirement savings plans.
So Zach, let's look at some things that will directly affect individuals as they save for retirement. It seems like one of the biggest changes affects the mandatory required minimum distribution age for IRAs and other retirement plans. Is that right?
Yeah, so effective with the Secure Act, the RMD age has changed from 70.5 to 72. However, individuals under 72 already taking an RMD will continue to do so. This only impacts people that turn 70.5 after December 31st, 2019. So if you turn 70.5 on January 1st, 2020, you'd be under the new rules and could wait until age 72. If you turn 70.5 on December 31st, 2019, you're going to need to take your RMD now under the old rules. Another interesting change along with that is the law also removed the age limit on contributions to a traditional IRA. So previously, once you hit the RMD age, you could no longer contribute to a traditional IRA. Now, as long as you have earned income, there is no age limit. This may open the door to new planning options, such as Roth conversions in those years, which could be integrated with clients' estate plans.
Interesting. So in the past, that age 70.5 was also associated with something called qualified charitable distributions. Did this change affect what people were able to do or when they were able to do qualified charitable distributions?
No. So qualified charitable distributions, or QCDs, allow anyone over the age of 70.5 to make a charitable contribution directly from their IRA. Rather than taking the tax deduction, that amount doesn't even show up on your tax return. This is a great planning tool for clients who want to give charitably and also take the standard deduction. That age remains 70.5 for everyone, even if you don't start taking your RMD until age 72.
All right. So that we know there are also some changes in the bill in terms of how people who inherit IRAs and qualified plan assets are required to take them out. Some people used to refer to things called stretch provisions as ways to lengthen the amount of time that people had to take IRA assets out that they've inherited. But it sounds like some things have changed there. How's that changed?
When heirs inherit IRAs with pre-tax dollars, the old rules required beneficiaries to take an annual RMD, but that amount was based on the beneficiary's lifetime. This was sometimes referred to as a stretch IRA, as the distributions and the associated income tax could be stretched over the beneficiary's life expectancy. With the Secure Act, most beneficiaries will not be required to take an annual RMD, but will be required to have the entire account liquidated in 10 years. This will essentially speed up the rate at which beneficiaries have to pay tax on those inherited dollars. And then a lot of speculation along with that is that that's kind of the way the Congress paid for adjusting that 70.5 to 72. So there are exceptions to this rule. First, if the beneficiary inherited the IRA prior to January 1st, 2020, the old stretch rules will still apply. Even if the money wasn't received until 2020, as long as the death occurred in 2019 or prior, the old rules will continue to apply. And as far as exemptions, there are 5 categories of eligible designated beneficiaries that are exempt from the 10-year rule, which means they'll still take the RMDs based on their life expectancy. And those are, first, surviving spouses, second, minor children up to the age of majority. So that the 10-year window would start once they reach age of majority. And that also only applies to minor children of the beneficiary. That doesn't include grandchildren. Third, disabled individuals. Fourth, chronically ill individuals. And then fifth, individuals that are not more than 10 years younger than the IRA owner.
Okay. I know there is also some desire to help people planning for retirement understand how they could estimate what kind of lifetime income they might plan on from their savings, just as they thought about, well, I've accumulated this much money. What does that really mean in terms of an annual income for the rest of my life? What did the bill have to say about that?
As pensions continue to become more rare, and as you know, pensions provide a guaranteed income in retirement, Congress wanted a way to help retirees think more about their 401k plans in terms of annual income instead of just the account balance. So while not a guaranteed number by any means, it is designed to help put the 401k balance into perspective of income. So along those same lines, the Secure Act actually also makes it easier for employers to offer annuity contracts inside their 401ks as a solution to provide that guaranteed lifetime income. So previously, plan sponsors could do so. However, there was concern around liability to the employer if the insurance company providing the annuity went out of business and was unable to pay the promised income. So the Secure Act significantly eases the risk to employers if this were to happen.
I know in the past at Foster Group, we've looked at certain kinds of annuity contracts. And from time to time, we found that in many cases, they're more expensive for investors in terms of internal costs and maybe some sales costs. Does the new law protect consumers, retirement investors, in this case, plan participants from bad or costly products?
Yeah, so that's still a little unclear. It does seem like whatever annuity products are brought into the plan must be transferable or portable between plans. And in terms of quality of annuities and costs, it looks like plan trustees who are fiduciaries to the plan participants will still need to do due diligence and make sure all investments are available in the plans are reasonable cost and expected performance. There certainly is some concern in the industry that fees associated with the annuities could substantially cut into the employee's savings. This makes it all the more important for employees to understand the investment or annuity selections they're making inside their 401k and the associated fees.
Great. Sure, there's a lot of stuff going on in this bill, and I know there's more things that we could talk about that we haven't. But let me just ask you a simple question, Zach. As you think about the bill, would you give this thing overall for plan participants a thumbs up or a thumbs down?
Yeah, I think that's a tough one to answer because the jury's still out a bit. I think there's definitely some positive things in there for retirees delaying that RMD to age 72. That's going to allow for another year and a half of pre-tax savings. I was glad to see the qualified charitable distribution still remains at age 70 and a half. Kind of the concern or the questionable side, the stretch IRAs that may require beneficiaries to pay a little bit more on taxes on the front end. However, the fact they're not taking an RMD, there may be some room in there to do some tax planning, some tax savings around that. And then secondly, I'd also say with the annuities being in 401ks, I still think there's some questions out there on what those products look like, what the quality is, what the fees would look like. And so I think it just makes it all the more important for plan participants to understand the investment options that they're selecting.
That's a great summary. Hey, I know there's just a couple other things maybe that we haven't talked about that you mentioned before. So you had them put on a slide here for us. You just want to walk through recently what these other maybe notable provisions would be and how they might apply to people.
Yeah, so just a couple other things we wanted to point out. Earlier, I'd mentioned the removal of the maximum age for traditional IRA contributions, and some other ones specifically for investors. The bill also allows for part-time employees to be included in retirement plans. It allows for up to $5,000 to be withdrawn from a retirement plan penalty-free for birth or adoption expenses. and you still would have to pay the tax on that account, but the 10% penalty wouldn't apply. It allows for up to $10,000 for a lifetime of 529 plan dollars to be used to pay down student loan debts as well. For employers, there's also a tax credit available both for starting retirement plan and also for including an automatic enrollment provision. And it also broadens the rules around establishing multi-employer plans to hopefully give small businesses a little bit more access to retirement savings.
Thanks, Zach. There is a lot in there, and I'm sure as we go forward here in 2020 and beyond, a lot of those provisions are going to be worked out. People are going to be hearing about them at their places of employment, and then retirees or people planning for retirement are going to want to kind of consult their advisors to make sure they're taking full advantage of the new provisions available to them, as well as maybe some planning changes that might be required in their estate plans or transfer plans just because of the way beneficiaries are going to inherit those IRAs in the future. I'd like to thank all of you who are on the line watching this webinar today for joining us as well. It's always our privilege to share information that we think is important and might be helpful for you. If you do have any questions that you'd like to ask as a result of this presentation or other questions that may have come up in your mind, you can sure contact us. We would love to be in contact with you via email, or if you'd like to have a conversation in person or via phone with one of our advisors, we'd also really enjoy that conversation as well. Some people, as they think about retirement, maybe are realizing they might need a little extra help if they've been doing it themselves, or they're just wanting some second opinion on things that they're doing. Again, Foster Group loves to be available to help in any way that we can with financial questions and planning for your successful future. So thanks again for joining us. We hope to do this again real soon, and we'll see you then.